What's up, everyone? It's Scotty with Money Investing. So I've been waiting for Ray Dalio to address the entire situation, address what's been going on for such a long time now, for almost 2 weeks, with Silicon Valley Bank and, of course, the current state of the economy and the markets and where we are with our debt levels. So he posted a video which I wanted to go over and share my thoughts and share my opinions and perspective. The thing is that I'm finding it very difficult, unfortunately, right now, to be like super, super optimistic about the markets and the economy. And, when we talk about long term, right, when we're talking about some of the long term tailwinds for the US economy and the markets, sure, I mean, 5 years, 10 years from now, there are some trends that are playing out. We're going to see the population grow. We're going to see more and more people come online. The jobs prospect across the world, not just in the US, but we're talking globally now. They're going to improve. The purchasing power is going to improve. People are going to be spending more money. And that's just going to, be the catalyst for that long-term sustainable growth, right? That's why I remain optimistic about the long term, but I'm finding it difficult to be optimistic about the short to intermediate term. And by that, I mean, the next few years, right? In the next 1 year, 2 years out, considering all the signs that are coming up, right, with respect to the economy, the market, inflation, interest rates, unemployment, everything that we have talked about on the channel before. So I wanted to break this down for you and from Ray Dalio and what he actually ended up saying. And I've also done a video, with regards to this. We've talked about the national debt. Not a lot of people checked out that video, but I would highly encourage you to check that out if you have the time, where the clock is ticking and the national debt, of course, is a big piece of concern for the US. And there are, I think, now 71 days left until June 5th, where the debt ceiling needs to be raised. So in this video, I go over what the national debt's all about, the debt ceiling, the extraordinary measures that the government needs to take. Everything is discussed in that video, so definitely do check it out if you have the time. But let's just dive right into it. Ray Dalio's 2-minute views and perspective on what he thinks about Silicon Valley Bank and what it means for the economy. So I'm going to play that clip and then I'll share my thoughts here.
I was asked to share my thoughts about the Silicon Valley Bank situation. Want to convey that it's very indicative of what the whole economy is like. So there's its particular situation and the Fed coming in and guaranteeing all depositors. But it's a common situation. It exists pervasively. And what is it that I'm talking about? That there has been a lot of creation of debt to make investments. So for example, banks, insurance companies, they borrow money at a certain rate, and then they go out and they make investments. And when those investments have lower returns, go down in value, as stocks and bonds have gone down in value, or they don't have adequate yields relative to the cost of funding those assets, you have everybody losing money. And that is a pervasive situation that...
So that is such, an interesting way to put it. And this is, like you said, Silicon Valley Bank's failure is indicative of what the reality of the situation is, meaning that that is exactly what is going on in the economy. A lot of creation of debt has led to people holding on to assets on leverage, on debt, on margin, and banks do that as well. Insurance companies, banks, they borrow money at a certain rate, they make investments at a certain rate, and if those yields are not as high as what the rate of borrowing is, then of course everyone loses, everyone is underwater. Not only the banks and insurance companies themselves, but also people that have actually invested with them or deposited money with them.
This throughout the economy, the world economy, the US economy. In other words, the world is long, so long holding assets that they're betting go up, and they're leverage long, meaning that they have borrowed money to hold those positions. And so that set of circumstance, as we've been talking about, has put the Federal Reserve and our country in a situation where it's very difficult to create an interest rate that is high enough to provide a real return. In other words, a return after inflation, that is high enough to compensate you for holding that asset, to provide that interest rate that's high enough at the same time as not damaging those who have borrowed that money. That balancing act is difficult. And there's this big supply demand means that there's a need to borrow a lot of money. If you look ahead and you say how much money needs to be borrowed by the Federal Reserve, by the government, in order to deal with this situation, big deficits, that means they have to sell debt. There's a supply-demand imbalance. In other words, those who want to buy debt, what are they going to buy it for? They need to have a high enough real return. If they don't have a high enough real return, they can sell the debt, or their debt that they're holding, rather than buying that debt. And that creates a terrible imbalance. And so that imbalance is the nature of what's going on. So and they're not marked to market. A lot of these. If you mark to market, a lot of entities are in financial difficulty.
So what he says towards the end is that if you actually mark to market, a lot of these financial entities, right, a lot of these financial institutions are almost all in difficulty, right? They're almost all underwater. As I showed you guys in another chart, every single one of them is holding on to losses. Why? Because their, number one, cost of borrowing is higher than their yields that they're making on their investments. And number two, those investments themselves have actually dropped in value because interest rates have gone up. So those are the two big things. And he obviously makes that correlation with respect to how banks and institutions are doing with how the economy is functioning. And the government needs to keep selling debt in order to service their older debt, right? So they're kind of building on their deficits. They're kind of building on their mountain of debt. And it's just like a really, really big experiment, right? This is a big macro experiment that the government's doing that's been going on for decades now. And nobody really knows, right? What's the end game here? Like, I don't know. And Ray Dalio's obviously had some say in it. I mean, he does believe that, there's been, over the last few centuries, there's been several global reserve currencies that have switched over. So again, the reason why the US is where it's at is because of the reserve currency, because it's able to sell all that debt and there are buyers for that debt. If there are sellers, in other words, if the buyers of that debt, which is the bonds, if they're not able to make a real return that's good enough for them, and if there's, an imbalance in supply and demand, what's going to happen? A lot of supply is going to come in, lots of investors are going to start selling, and as a result, prices will drop, yields will skyrocket, thereby making it more expensive for the Federal Reserve to borrow money, for the government, for the Treasury Department to borrow money because interest rates are higher. And then the interest on their debt becomes even more expensive. And it's like a spiral, right? So what happens is if the US does not pay its debt obligations, it gets downgraded. Its debt becomes more risky if it gets downgraded. And if it gets downgraded, the debt becomes more risky. Thereby, the people or investors that are holding onto the debt, they're not going to be convinced that the US government is going to pay them back. They're going to start selling. And as they're selling, supply is coming in, prices are going down, yields are going up, their interest rate starts to go up, the cost of borrowing starts to go up, which makes it even more difficult for the government to pay on its debt obligations, which downgrades it even more, which makes it even more risky, which comes even more supply, more prices coming down, and interest rates going higher, which makes it even more difficult for the government to pay on its debt. So that's like a spiral, which we obviously don't want to get into. It's like a very, very disastrous type scenario, and of course, definitely quite a bit of a talking point. But I wanted to get you through this, what Ray Dalio mentioned, and the long term, as I said, there are both the bull case and the bear case. The bull case is, again, like I said, the population's growing, more people coming online, more purchasing power, more spending, inflation comes back down, interest rates come back down, and that's the bull case long term catalyst. And there's a lot of QE. Again, I don't really vouch for QE. I don't like QE, but QE is also part of the bull case. But the bear case is an experiment, right? The bear case is a pretty big experiment with respect to the national debt and what ends up happening over, the next few decades with respect to interest rates, with respect to the debt markets, the capital markets in terms of the US, and of course, what's going to happen with the mountain of deficits that we are building on every single year. So I hope you guys enjoyed this video and found it helpful. Let me know your thoughts down in the comment section below. Again, just kind of going over some of these topics here. Let me know in the comment section below, what do you think? As always, if you enjoyed this video, found it helpful, make sure that you drop a like, subscribe to the channel. Happy investing. I'll see you all in the next video.